afternoon, ladies and gentlemen, and welcome to today's presentation for the Power Options Radioactive Trading Open Discussion Open Forum for this Friday, February 25th, 2011. It's great to see you all here. We still have some other people joining us in the room. I'm expecting a relatively small audience today, but that'll work out well. It just means more time for the questions that everyone who's joining us has, so we can spend a lot of time on those questions. Let's see. Well, before we get started today, I just want to introduce myself, of course. My name is Mike Chupka. I'm the Director of Options Education here at PowerOptions. PowerOptions, of course, is a patented suite of search and analysis tools. We support over 23 different option strategies. We have tools, of course, that allow you to search and scan across the universe of options to find only those positions that match your personal criteria and your risk-reward tolerance. And we also offer tools to help you further research, analyze, and evaluate those positions, and then portfolio tools to track and manage those positions. I've been with Power Options for 8 years. I've been trading as well for about 8 years. I handle a lot of the coaching sessions and education. That's important. Anyone who's on a free trial or is a subscriber to Power Options, you can sign up for one of those free coaching sessions. They're completely free. You can have as many as you want. We never charge for them. And they're usually a 40 to 50-minute phone conversation where we'll walk you through the tools on the site, answer any questions that you have, and show you, of course, how we would use the tools to implement the strategies that you're interested in trading. I've co-authored 2 books on options investing with Ernie Zarrenner, the president and founder of Power Options. And I am versed in all strategies on the site, but there are some strategies I do not trade in my personal account, things such as iron butterflies, short straddles, short strangles, and naked calls. They don't match my personal risk-reward tolerance, so I don't trade those in my personal account. But if you have questions on how to use the Power Options tools to implement those strategies, please feel free to ask those questions at any time or during today's webinar. All right. Okay, the processes and procedure for tonight's presentation. Ask as many questions as you want. Use the question pod there to go ahead and pose your question. We may not have time to answer all the questions, but I'll usually stay on a little bit extra if we need to spend another 10 or 15 minutes in order to handle some of the other questions that have come in. Of course, questions can be really about anything related to options investing. If you have questions on the tools on Power Options, any of the radioactive trading techniques, the Power Options Applied service, or just general options strategy and education, please feel free to just send those questions over, and we'll handle them during today's presentation. We just ask that be patient. There may be several questions ahead of yours. We are going to try to get through them all, the questions that come in. We want to encourage everyone, of course, to feel free to help us help others. If one of our attendees asks a question, let's say about naked puts, and I'm providing an answer based on my experience, but your market experience, I should say, has given you a different kind of approach to it, or you've seen something different than my comments or my experience, use the question pod to send that to me, and I'll share it with the group. And most important, it's Friday. It's the end of another week, getting another week now closer to March expiration and the month of March itself. So let's relax, let's have some fun, and get some good education. And before we launch into our questions for today and start receiving those questions, we're going to spend a few minutes with reviewing some other things. And the first thing we're going to do, of course, is run our basic search for the weekly options. So we're going to look for the positions next week that have weekly options expiring next week. At last count, we had 50 optionable stocks, ETFs, and indexes that supported the weekly options. We're going to run that search today to see if anything new was released yesterday. The weekly options are typically released the Thursday before the current expiration, so you have time to make adjustments if you need to. Also, for those of you who were with us last week, during that search, what we do is we typically just run a naked put search to identify the weekly options coming up. Just one strike for each of the stocks. We can get a count of how many stocks and ETFs there are. We had a discussion. We had a customer with a question on which would be a better trade if I was bullish on one of these stocks. Would I do a naked put? Would I do a bull put credit spread? Or would I do a naked put position? Now, we did that in the portfolio. We entered 3 paper trades, a naked put on AIG, a bull put credit spread, and a diagonal calendar put spread. And today we're going to look at that briefly before we start to see how all 3 of those panned out. And they all panned out badly. But what is the level of badly that each one performed to? That's what we're going to take a look at. All right, so let's navigate over to the PowerOptions suite of tools. And I'm going to go right into the naked put search, and we're just going to show how to just create a basic search looking for weekly options with the naked put menu. So I'll click on the naked put tab here. This will take us to the naked put homepage. And then I'll go ahead and click on the search tool from the sub-menu. All right, and this is going to pull up a list of potential put options that match our basic or default criteria. And it looks like we already have a saved search, so we don't have to show how we would have created this. But just for review, what I would have done if I put up the standard search or one of the initial value searches on the naked put menu, we simply would have scrolled down to the bottom of the page. We would have clicked on clear these settings. That would have emptied out all of our criteria. And then I would have selected to put in the days to expiration between 2 to 9. And then at the same time just selected the number of strikes out of the money of 1 to 1. What I'm doing here is I'm only trying to see one strike on the weekly options for each of our available positions. Okay? All right. And the reason why I selected 2 to 9 is so we wouldn't have today's weekly options, the weekly options that are expiring today that technically have 1 day left. We only want to see the ones from next week. So that's why I put in a days to expiration field of 2 to 9. Now, this is the weekly stocks, and we have 31 results. Technically, we have 30 stocks and 1 ETN. Now, how did I identify just the stocks? Well, when we scroll down below into our parameter field, notice how I haven't put in anything for yield or any of the stock criteria. We just looked for weekly options and just the one strike out of the money. But in the fields down below, I have a selection field for recommended lists where I could screen just against stocks in certain company lists, or if I just wanted to look for the weekly options on our indexes, ETFs, and holders, I could have selected that. But what we did here is we removed the indexes, ETFs, and holders, so we're only seeing those stocks now that have weekly options. Let's change the remove list to no list, and we'll see the total counts of all ETFs, indexes, ETNs, of course, even, and stocks. And we're still at 50, so we do not have any new stocks or new ETFs that are now offering weekly options from last week. All right, we're still at 50. But of course, next week we'll run this again, and we'll see if we have any new examples. All right, so let me go now to the PowerOptions portfolio tools. I'm going to click on the My Portfolio tab. And we're going to select profit and loss portfolios. And last week when we ran that weekly search, we chose AIG as an example. And we entered a short put or a naked put position. You can see now it has just 1 day left to expiration. Technically it expires in about 2.5 hours, I believe, is when settlement occurs for the weekly options, around, I believe, 6:37 p.m. Eastern Time. And here's our bull put credit spread. We sold the 41 put for $1 and purchased the weekly 38 put on AIG for 22 cents. We received $1 for the naked put as well. And then we did a calendar put spread. We sold the February 41 put for $1 and at the same time bought an out of the money August 38 put for $3. So we had a net debit of $2. That's the most we could lose on the position. Well, as you can probably see, the stock's now trading at 38.41. We had a bull put spread, a naked put, and we did create sort of a bullish calendar put spread. We were working with the idea of, hey, which one of these might be safer to enter if we were slightly bullish, but we wanted to have some protection. Would the bull put credit spread be better than the naked put? Would the calendar put spread, setting it up in this fashion with the out of the money put, using the put that's further out in time, which one would work better? Well, because the stock dropped, none of them worked well. We scroll over to the right here, and remember to see these extra fields I have that show the total position cost for the spreads, the original expected gain or loss, the liquidation current gain or loss, and the expiration gain or loss. We can see our total view here. Now, there's something interesting there, but I'll explain that in a moment. But what we see here is that right now, if we liquidated this position on the naked put, we'd have a loss of $162. We received $1 up front, but it would cost us $2.62 to buy to close the put. So we're going to have a loss of $162 but it's only a 4% loss. Remember, if I sold the 41 put on AIG, most likely I would have put up $41 per share to cover the sell price, or the sale price of my option. So this loss of 162 based on the margin requirement of $41 works out to be only 4%. You might as well assume that the liquidation loss is pretty much close to the expiration gain or loss, except for in the calendar put spread, and we'll talk about that in a moment. Now, the bull put lost us more. We have a loss of $184 in the bull put spread right now, which is pretty much close to the maximum risk. There's still some time value. It would cost us $262 to buy to close the short put, and the bid price listed for the long put that's now out of the money is 0. It's probably a 0 to 2 cent bid-ask spread. It just has a 0 bid listed because there's no activity. So it costs us $262 to close the position. Since we didn't make any adjustments on this bull put credit spread and it's now in the money, it went against us. Both puts are now in the money. Today it's 6:30 or 7 p.m. Eastern Time. What my broker would do is I would be forced to buy shares of stock, AIG at $41. That's the obligation of the short put. But then I could sell to close them at $38. So I'd have essentially a 3-point loss between the position. But I keep the 78-cent net credit that we originally received here. So our loss would really just be that the $3 there minus the 78 or the 262 as we're seeing effectively. Okay, so pretty much, and that loss is huge compared to what we were expected to make. We were only expected to make $78. So this 235% loss is based on we're losing $184 when we expected to make 78. So we lost 235 times more than we expected to make essentially. So the bull put did not work out well at all. Would we have managed this differently if we were actually trading these positions? Of course. But we just wanted to use this as an example. If we turned a blind eye for the 7-day period, how would these 3 positions have worked out? Now the calendar spread gave us sort of the biggest leverage return. Our expected gain was about 110 or 54.8%. That's of course if the stock was trading right at $41 on today's expiration. And we were holding a long-term August 38 put. Now if we liquidated right now, because the long put still retains some of its time value, our August 38 put still retained, it went up in price, but it retained a lot of its time premium as well, at $335 right now. So we'd only have a loss of 127. This is actually the smallest loser. But what's interesting is that we still have a potential to make a higher profit. Now why is that? Well, what it's looking at is that we could still potentially perform other trades against the 38 put because it does not expire today. If the stock was trading, that's assuming the stock was trading at 41, which we know is not going to happen. But with this being closed out for a loss, the 38 put will still be open. With the stock at 38.41, we might be able to sell a 39 strike put against our 38 put now and generate more premium, lower the cost, and we continue to roll it to August expiration. It's easier to manage a calendar spread because that long position you're still managing. Now we're not treating, we didn't do a collar either on AIG, and we didn't compare it to a, let's say a married put, for example, and how would we manage that? We're just looking at these 3 positions based on selling put from what one of our customers asked us last week. So we had the short put, which lost a significant amount of money, but it was a small percentage based on our margin. We really got crushed percentage-wise and pretty much monetarily on that bull put credit spread. That went completely against us. And the calendar spread is showing a significant loss right now as well, but we have more time to manage it because we have the August put in play, so we can continue to roll the weekly options against it. And maybe we'll do that. Let's go ahead and do that. So if I was going to roll this leg, the February 41, for example, I'd just click the More Information button. We'd go to Position Actions, and now I'm going to roll the leg. So I'm going to simulate that right before expiration, if I had to pay $262 to buy to close this original put, well, it says $254 now, but let me go ahead and change that to $262. It's about the range in the money. So I'll buy to close my original put, and with the stock down now at 38, let's see what we can get for next week. So here's what's expiring today. Oh, it did change, 241 by 254. Okay. So hold on one second. Let's go back. 254. Okay. All right, so let's go to our next weekly option. And the stock's now at 38.54. We do have the 38 long put, so if I sold the 38 put now, we'd have a horizontal diagonal spread. Maybe we're expecting it to go up, so we might not want to risk the 39 put because it's selling a put that's in the money. We'd need the stock to move up 46 cents, excuse me, from 38.54 in order to have that expire worthless. Might be a little bit chancy. So let me do the 38 put. We'll turn this into a horizontal horizontal calendar spread. So I'm going to sell next week's March 38 put. We're just keeping it at one contract, zero commission fee. We're going to collect 57 cents. Just take the natural bid price. Let's go ahead and submit that. And then we'll have that now in our portfolio. So we still have the calendar put spread, but now it's linked to that short 38 put, which expires 7 days from now that we collected 57 cents for. All right, we'll see how that performs next week. And maybe this week we'll even do some other positions, add them into the portfolio, and evaluate them next week as well. All right. Okay, so we've got some questions coming in. Let me go back to the main home menu before I address these. And Ivan's question, he's referring to an HPQ example. I guess this is from the blueprint. I don't have that in front of me, but that's what I'm assuming you mean. On December 10th, sold a 37.5 call. On January 6th, went up to 39.53 and is not assigned. Based on your experience, what is the difference between the stock price and the strike price that is safe to avoid assignment? There's no answer to that question, Ivan. I've seen positions be in the money by 2 cents and get assigned a couple weeks early, usually in the range of an ex-dividend date. I've seen positions that were 20 to 30 cents in the money and were not assigned. Rules have changed also in recent history, or in the past year, the past several months. By rule, any option that is now, I believe, 1 to 2 cents in the money, any unclaimed option that's 1 or 2 cents in the money at expiration will be assigned. Now, what I mean by unclaimed, let's say you had a stock at 50. Let's say you had a short call at 50, and the expiration day was today, and the stock was trading at $50.02. Okay? So if I'm the option buyer on the other side of your covered call, Ivan, and I decided not to exercise it, I didn't want to exercise the call, I didn't want to bother buying the shares of stock, I'd just take, maybe I paid $1.50 for it, but it's essentially a worthless option, now it's only at 2 cents. So on my side, maybe I just wouldn't buy the shares of stock, or maybe I just sold to close it for 2 cents. But what's going to happen is if I don't claim that, if the option buyers don't claim your position or your calls are not assigned, on the Saturday of expiration, the Options Clearing Council is going to come in and they'll assign all of those options. So anything that's at least 1 or 2 cents in the money is going to be assigned for you by the Options Clearing Council. Regarding early assignment, it can happen any time. That's the key. Whether you're 5 cents in the money, whether you're 10 cents in the money, or whether you're $10 in the money, you can be assigned at any time. That's the key to remember. It's really irrelevant. There's no one answer to this question. There's no safe range to avoid assignment. If you're in the money, expect to be assigned. It could happen early, and if you don't manage it by expiration, you are going to get assigned. Yes. Okay, Ivan had a follow-up question. Before expiration, can they assign? You can be assigned at any time. That's right. If your call is in the money, you can be assigned at any time unless you're trading a European-style index or a spread on a European-style index. I believe, for example, $XEO is a European index. Those can only be assigned at expiration. They can't be assigned beforehand. But the American-style options, for example, those positions we just saw in AIG, for example, or any calls on Apple or SPY, if they're in the money, if you have a covered call and it's in the money, you can be assigned at any time. Typically, you don't see early assignment that often. It usually only happens in the case of an ex-dividend date or maybe even before an earnings date. But just remember, they can happen anytime. I've seen some strange things happen. I've been assigned on a stock on a collar position. I was in a standard collar position. I was about 45 cents in the money, and I still had 2.5 weeks to go to expiration. And as the stock continued to move up, I was just thinking about, yeah, I should manage this. I should probably adjust this position. And I went to my broker, and it turns out I was actually assigned the day before. I still had 2.5 weeks to go to expiration. There was no ex-dividend date. There was no earnings date coming up, but for some strange reason, I was assigned on the short call, and I just had a long put left. And okay, well, I'm going to have to look at manage it then. Oh, yeah, okay, follow up on this one, too. As long as the percent of assigned is sufficient, that should be okay, right? Absolutely. Absolutely, okay? Let's talk about that for a minute. Let's just run a basic covered call search. And I don't like to use annualized percentage returns too much in these situations because it can be drawn out of proportion. But let's just take, let me go with the in the money search, so I want to see positions that are already in the money. When I run a search in any strategy, I've put in the criteria for the stocks I want to trade that I feel are, if I'm in a bullish strategy, stocks that I feel are strong ownership and are good bullish positions. And I'm only selling calls against those positions that match my percent return if assigned, my percent if unchanged, and my downside protection requirements. So first one we have here, Verifone Holdings, symbol PAY, currently closed today at $45.94. This is not a recommendation or suggestion. This is just a default in the money search, of course. Now, the 43 March call, which expires in 22 days, could be sold for $4.20. I don't know if this stock has earnings coming up or not, but that's a pretty decent premium. So this would lower our net debit to $41.74. If the stock stays above 43 at March expiration, we could expect to make 3%. That's the maximum we can make, right? Let's take a look at that profit and loss chart. Stock's trading above 43. If we just leave the call open, we can't make anything more than that 3% return, of course. All right? So there's our covered call trade, and let's just click it to expiration here. Now, the curved line, as you know, this shows us what the position would look like at the halfway point, halfway between now and March expiration. In this case, that would be March 9th. If I liquidated the position by buying to close the stock, buying to close the call, and selling to close the stock, I wouldn't reach the full return because there's time value still remaining. But on 3/9, if someone exercised me at 43, well, that's great. Let's say tomorrow I get assigned at 43 and I make that full profit. Well, that's great. I made it in 2 days. I don't have to wait another 22 days. I got assigned early. If I was fine making this 3% return over a 22-day period, I'm absolutely fine making that 3% return over a 2-day period. I can take that capital now and move into another position. So yes, once you've identified the position, if you were comfortable with the return to begin with, if you get called out early, you get called out soon, you're going to be happy with that as well, the covered call. Naked put, of course, is the opposite. You can't get you have the same profit and loss chart with a naked put, but you can't get assigned. You have to wait until that expires. If you get assigned on a naked put, that meant the stock has dropped below your put strike price, and now you have a loss. John, I knew this was going to come up, and I sincerely apologize for it. There was apparently a problem with the YouTube link. As you know, what John wanted to know is, as far as I know, the webinar from Wednesday night, Part 5 of the Power Options for Radioactive Traders series, was not posted as quickly as I wanted it to. Since we spent an hour and 48 minutes on the line, and the size of the webinar was rather large, it took a long time, and it failed once or twice when we were uploading it to YouTube. So we had to try to do a workaround for that in a different format. We finally got that taken care of. It was posted about 10 minutes before the webinar started, and I did expect to get questions on that, John, because I knew I hadn't replied back to you since you called the other day. And I did expect to have it up Thursday morning, and we just had ridiculous problems with YouTube getting that large video loaded. But it's all there now. Part 1 through 5 of the Power Options for Radioactive Traders. Part 1 was using the search tool. Part 2 was using the open discussion on the Power Options search tool for RPM's radioactive profit machines. Part 3 was just on further researching and analyzing the positions, the RPM positions we identified in the search tool. And Part 4, of course, focused on the portfolio tools, and Part 5 was the last part, our open discussion Q&A. So it was an hour and 48 minutes, just like we're doing today, just customer questions on using the Power Options tools for radioactive traders. They're all posted now. I haven't decided if I'm going to do a Part 6 or not yet. I'll probably decide that sometime next week. And if we do have a part 6 in that series, it actually won't be until after the second week in March. And it'll be probably around the 20th. Yeah, about the 20th of March, 21st of March if we have another one in that particular series. But okay. And of course, all of the webinars, to access them, just go to the main home menu or the main home tab. Click on Learning Center. And then from that Learning Center menu, select Webinars. And that will get you to all of our archived webinars, of course, and show you the upcoming live webinars as well. Okay. What other questions do we have? It looks like we've answered all the ones that have come in so far. If you have a question, go ahead and use the pod there. Send me over the questions that you have about the PowerOptions tools or about radioactive trading. Jack, I see Jack joined us. Jack, great to see you. I received your email this morning. I got a chance to take a look at the attachment that you put in with that. But due to the call volume today and a couple of things I was working on with the programmers, I haven't had a chance to run through the analysis on it. So I'm working on that. Might be able to get you a reply pretty soon on the position that you had there. It's not advice that I'm referring to, of course, to everyone online. I'm not giving advice to Jack. Just taking a look at some of these, the positions that he did and his management of this particular position. I'm just going to give him some feedback if I notice anything that seems out of place or if I would have done something differently or, you know, what ways could he have avoided doing certain things that got him into trouble or enhanced certain things that worked out well for him. Okay, John wants to know, can you go over putting the Zacks rating of the stock in the search function? Yes. Let's just go back to that naked put menu, for example, and let's go into the search. And this will pull up our weekly options again, but we're going to just change that whole search field. Let's just go back to one of the defaults on the naked put screen there. I'll want to go with... let's go with this out of the money one here. Let's see what we have. Oops, sorry about that. Went down, scrolled down too far. Okay. Oh wow, there's only a few results here. Trina Solar, Verifone, Finisar. These must be some inflated premiums. I bet you these guys have earnings coming up. Let me run a quick test, John. Before I do that, I'm going to select here in our search to only see the put options that match the other criteria but do not have an earnings between now and expiration. We have 12 results right now, and yeah, okay, so we narrowed it down to 4. All right. Oh, Ancestry.com's on there. That's interesting. That's what I figured, though. The smaller yield positions at around 1.5% with 22 days, those are the ones that don't have earnings. The positions we saw that did have earnings, those are the ones with the inflated premiums, of course. All right. Now, what John is referring to, in every strategy, you'll have a choice here for the average broker recommendation. This isn't the Zacks rating. It's a Zacks scale based on the broker recommendation. Now, what I'm screening for here in this particular default search in the naked put menu is screening for an average broker recommendation of less than 2.6. That's an odd number. And why am I looking for things with a low rating? Well, not really. The average broker recommendation, this is based on the Zacks scale, where a rating of 1 is a strong buy recommendation, 2 is a buy recommendation, 3 is a hold, 4 is a sell recommendation, and 5 is a strong sell recommendation. So if I only wanted to see stocks that had a hold recommendation or better, I would just use an average broker recommendation of less than 3. So that would show me everything that's a 1, a strong buy, 2, a buy, 3, a hold. Now, since there's probably 18 or 19 brokers who are technically voting if it's a buy, a strong buy, or hold, for example, when you average them out, that's when you get the decimal points. You might have a 2.7, you might have a 2.4, you might have a 1.8 recommendation based on, let's say, 8 of the brokers voting as a 1, 7 of the brokers selecting 2, and 2 of the brokers selecting a 3. So that might give you an average of around 1.8, 1.9, for example. But, you know, to lower that down a little bit more, if I only wanted to see those ones that were, let's say, between, they weren't all the way up to a hold, but were just between a buy and a hold or lower, then that's when I usually use a range of less than 2.6 or less than 2.5. don't ever put in a search of less than 1 because you typically won't find anything. All right, there's no such thing as a 0 rating on the Zacks scale. It's only a 1, 2, 3, 4, or 5. So you never want to put in a broker recommendation of less than 1. You won't get any results. Okay? Or if you screen for something less than 0.5, you wouldn't get any results either. Okay? Let's get back to 2.6 there. Now, if I was in a naked call screen, which, as I told you, I don't trade in my personal account, but if I was looking at a naked call position, which, remember, is a bearish position, when I sell a naked call, I'm expecting the stock to stay at the same price or move down, so my call expires worthless and I keep the entire premium. In that case, instead of looking for an average broker recommendation of less than 2.6, I might look for an average broker recommendation of greater than 3 or greater than 3.5. So now I'm looking only for those ones that are between a hold and a sell or a strong sell recommendation. Okay, so that's the ratings for the average broker recommendations based on the Zacks scale. Oh, married put search, I'm sorry, John, same thing. Okay, I didn't see that until after I started answering your question. No problem. Let's go into married puts and we'll go into the search. I believe I've got my radioactive screen up there already. Or one of the ones from our webinars. Yep, selected search for part 3. Now this is interesting. We did part 3. John, you might have to refresh my memory on this. We did part 3 of that webinar series, which we were talking about the analysis, I believe, and the analyzing the search result. Oh, no, this was, yeah, analyzing the search results was part 3. That was held on Tuesday the 8th. We had a customer ask a question, and we went through, we did this screen for part 3 of the presentation, where we were looking for, of course, the time frame of 150 to 385 days. We kept our risk under 15%, risk of 3.9 to 7, open interest greater than 0, and so forth. And I put in a broker recommendation of less than 2.21. And the reason why we put that in there is that there is we were looking for something specific at the time. But what we wanted to do was identify a position that was just, in theory, what this, Ernie's done the numbers on this before, but what this will always show you is, in addition to showing you only those stocks that are a buy or strong buy recommendation, usually only just a 1 or 2, maybe 1, 3 in there. But this low value guarantees that the number of 1 votes, of strong buy votes, will be greater than any of the 2 votes or 3 votes. So you have a large basis towards the brokers who are voting a 1 for strong buy. Actually, I think it's 2.25. I don't know why I had 2.21 in there. I think that was just an example of why that was there. When we ran this search, though, on the 3rd, which was based on the search we used in part 1 using the search tool, we had, I believe, 25 different positions, and some of those positions that were there, we had multiple strike prices for the married put on Valero, TLM, Talisman Energy, for example, CarMax, KMX. And those are the examples we started using throughout the series, the educational series presentation. It's amazing what half a month will do, right? From the 8th until the 25th, about 17 days later, I don't think any of these combinations, Corning, General Electric, Moody's, Discover Financials, were on this same search we ran back on the 8th. Stocks had dropped in price, implied volatility had jumped up as well, so that kind of got everything in trouble. But I'm curious, John, before I answer your other question, I want to see if I'm thinking that I did use this search. Here's what I'm going to do. Let's have some fun. Let's go into the backtest. And very quickly, from the married put backtest, I'm going to click on Smart History Excel. We're going to run a historical search. And what I'm going to do is actually select February 8th. That was when we ran part 3. That's when we had part 3 of our presentation, as the night of February 8th. And I'm going to select that part 3 search. See if we had the same results there. Okay, Moody's was there, and Corning was too. I lied. Caught me in a lie. I don't remember seeing them during that presentation. But here were the search results. That same search we ran just now, which only had 7 results with GE and Corning was in there, we saw, and as was Moody's. Oh, there is GE. There was a GE in there. How about that? Okay. Corning was in there as well. But when we ran the search, I was focusing on the CarMax position, the Talisman Energy position, and the Valero position. And this one kind of makes me laugh. Valero was at $28, and it was a 31 put with a 5.1% at risk. I was looking at that, and then shortly after this, Valero I think went up to I think it broke $30 briefly, and it was definitely at 29. And the past few days, it had pulled back to 27. I was actually thinking about doing this particular RPM. Actually, I was thinking about doing it with a 30 strike yesterday and the day before when it was down at around $27. Of course, what happens today? Well, we all saw what happened today. After those 3 days down, the stock jumped up about another $1.20, I believe, at one point today. So Valero was back up, and I didn't enter the RPM, as a matter of fact. But the other two, I did end up going into those positions. But with CarMax, I think I took this 37 put, and I believe with Talisman Energy, I did do the 25 for July, I believe, which is no longer 150 days out in time. I think now it's only 142, 143 days out in time. All right. Yeah, Jack, that's the obvious answer, but I'm not just going to give you that answer to the email you sent me earlier. Hindsight is 20/20, but I'm going to look at some of the actual adjustments that you made and kind of go through some thought process of what I might have done there as well, rather than just say, yeah, hindsight 20/20, could have just left the position alone, it would have worked out well, but we want to take a little bit deeper look into that to help you as you're looking forward to doing other adjustments on your other positions as well. All right, John wants to pick my brain. If there aren't many other questions, perhaps you could go over a new married put search and how you'd go about it and why you chose a stock. And I know that is review. Yeah, we covered that in those other webinars, but I'll walk through essentially not just for married puts, of course, but I'll walk through it with an eye to how I would do it on any search. Not my settings, not my personal settings, but what am I going to focus on when I create any new search in any strategy? All right, so let's go ahead and do that. I'm going to go into married put, and we're going to go into the search tool. Step one is I'm going to scroll down to the bottom and hit clear these settings. I'm going to empty everything out of the parameter field. Now, when you're creating a search in any strategy, I don't care if you're doing, well, I don't, that's a bad phrasing. I care, of course, what strategies you're doing. That's why you're my clients, and I want to hear your questions so I can help you if you have any questions and, you know, impart any knowledge I have that might help you, and, of course, using the search tool to make that better. What I meant was regardless if you're trading bull puts, credit spreads, bear put, debit spreads, for example, if you're trading iron condors, if you're just doing covered calls, if you're doing standard collars, if you're doing married puts, if you're doing calendar spreads, what have you, when you go in to create a search or you're going to go into a strategy, you have in your mind, you should have in your mind, most likely 5 to 10 criteria that you know you're going to use directly. All right, what do I mean by that? Well, for example, when I trade a married put, I'm following the specific rules and the specific methodology of radioactive trading in the blueprint. So what are the basic rules I know I have to follow? Number one, I'm going to buy a stock and buy an in-the-money put that's not more than 20% in the money, that's at least 150 days out in time, and at the same time matches my risk threshold. So right there, that's essentially, there's 3 criteria right there alone, but really it's kind of more along the lines of 5. And why is that? Well, first, the time frame. I have to be at least 150 days out in time. I can go maximum to about 2 years out in time. I think the January 2013 leaps are 695 or 694 days to expiration. But I don't have to limit the farthest side. So that's my first thing, 150 days. I said that I'm not going to look for positions that are more than 20% in the money. That's following the rules. But again, not because I've been trading this for so long, but you know, after a while you say, well, what if I wanted to restrict it to be only 15% in the money? I don't want to go more than 15% in the money. Well, I can restrict that as well. But I'll just leave the 20% in there for now. My risk. Why am I trading in this position? To limit risk. What kind of limited risk am I looking for? Well, right off the bat, I know that when I'm using insurance, I personally my risk threshold is to not risk more than 7, maybe 7.2, maybe 7.3%. I don't like going higher than 7%. But I also know that there's such a thing that's discussed in the blueprint, of course, where he talks about too little of a risk. So typically my risk is going between 3 to 7%. I fine-tuned a little bit more than that, but this is just a basic view. Just entered 3 criteria alone. Don't have any stock information yet or anything else. But what are some of the other things right off the bat I know I might want to put in? Well, I know that I'm going to want to see some liquidity, but got to keep in mind how the market works. I'm looking for put options that are at least 5 months out in time, 150 days out in time. I know that there's not going to be a lot of daily activity on those far out options. I could decide to screen for an option volume today, let's say of greater than 0, just to see positions that traded at least 1 contract today. But what I really want to focus on more is the open interest. I'm going to want some liquidity, maybe 10 contracts, maybe 20 contracts for those put options. Let's just start with 10, okay? All right, now let's run our search. I have no stock list selection, no stock criteria. We are sorting it by lowest maximum risk to highest, and we have 334 total results. So out of all 3,200 optionable stocks and ETFs, the indexes aren't listed here because you can't buy shares of the ETFs. I'm just pointing out, with just those basic criteria, I've limited down the 3,200 optionable stocks and ETFs, and roughly excluding the indexes, probably about 310 to 320,000 possible combinations. Let's be realistic. It's actually more along the lines of 160,000, isn't it? 160,000 put options, because there's 350, it's close to 350,000 total options, calls, and puts. So let's just cut that in half and say 160,000 puts here. In those 3,200 stocks, we only have 334 total results. The other ones would be outside of our risk range, would be too far in the money, for example, or we'd be too close to the days to expiration. So we've narrowed it down, and plus we just said open interest. Now remember, I didn't focus on this when I first, let me just open the CVS Corp one. I didn't focus on this when we first went to the Married Put homepage, but let me just go ahead and pull up the profit and loss chart. When you go to any strategy homepage, you see the profit and loss chart for the position over on the right-hand side. It's a blue hockey stick graph. Why is this important? Well, without showing it even in this fashion, we're just looking at the hockey stick graph for the position. What do we know? If the stock falls or stays at the same price, we'll eventually lose money. We make money when the stock goes up. What does that tell me? I want to put in criteria that I would normally use to identify stocks that I feel are moving up. What are some of those filters? Well, everyone has their own different way of doing it. This is why on PowerOptions we offer 30 to 40 different types of stock criteria, because everyone's going to have a different way. Considering this is more of a long-term growth position, because I'm buying a put option that's 5 months out in time, if I make my goals in the next 30 to 40 days, fine, no problem there. But if I don't, I'm okay maybe holding it for 3, 4, or 5 months because of limited risk. So, I did go one step ahead of myself, didn't I, John? We went one step too far. Why is that? Well, there's something else here I forgot to mention. In this position, in this strategy, what am I doing? I'm buying stock and buying a put. So in addition to knowing that when I'm buying insurance, I want to have less than 7% risk, I want some volume, and I want some liquidity, and I'm following the rules to be 150 days out in time and not go more than 20% in the money. Well, I also know my account size, don't I? I'm not going to be, if I'm trading with $25,000, $30,000, or just maybe putting $10,000 or $15,000 into this strategy for now, I'm not going to be buying $100 stocks or $80 stocks or probably even $65 or $70 stocks because of my account size. So I'm going to lower both my net debit and my stock price limitation. The net debit is the total cost per share, price per share of the stock plus the put. So I'm going to put my maximum at $55. And I'm just going to put my strike price range, let's say between $5 and $55. $5 to $60. $55 per share as well is fine. Yeah. So the net debits already take care of that. I don't need to put in both. If I limit the net debit to be between $55, then it's not going to go any higher than that. All right. So let's go ahead and run that. I just wanted to run that down. Okay, so now it's 146. And I guess I misspoke myself here because John pointed out that I must have said something funny. You only ever trade stocks that are greater than $300. All right. Okay, so there's my limitation too. That narrowed it down almost that cut it more than half, didn't it? Because I did want to include the stock price. All right, but now, I want to look at some fundamentals. What would I look to identify a bullish stock? Well, I might use stocks that have grown in earnings from last year this year. Let's say grown at least 5%, the earnings per share growth. A lot of investors like to use a PE ratio, some between the range, a little restricted range, maybe 0 to 40, some 0 to 50. I think 0 to 50 or 0 to 70 is pretty good, but let's run 0 to 50. And let's take that broker recommendation, John, because you had mentioned it. So let's just say we want to look for stocks that are between that buy and hold or strong buy recommendation. So we'll look for a broker recommendation of less than 2.6. Let's go ahead and submit that. Okay. Down to 83 results. Further limiting it down as I go, aren't I? All right. Other things, how about average stock volume? Maybe you don't want to trade lower price stocks, some of the stocks that might have a limited risk but are trading in the $5, $6, or $7 range. Maybe you only trade on average 200 or 300,000 shares per day. We might want to use the average stock volume. This is measured in thousands, so let's only look for those stocks that trade at least 500,000 shares per day on average. Okay, and so now we're down to 82. Didn't limit it that much there. Okay, and we can just continue on in this fashion. I mean, already we're down to a fairly limited number of results, and we probably have some duplicates here, so we could restrict the range a little bit more. But let's say that you also only wanted to get into, this isn't a recommendation or a suggestion, but let's say that right now you only like to buy stocks or look for stocks that are currently in an uptrend. So you could use the simple moving average field to select stock price to be greater than the SMA 50, for example. Now that's going to narrow it down a lot after the last couple of weeks, I believe. So cut it in half again. Now we're down to 47 results. Have I put in a lot of different criteria? No, I haven't. Have I put in a lot of complex and advanced criteria, Bollinger Band ranges or RSI? I could even look at market cap if I wanted to. That's a basic one. But I'm using anything for, certain implied volatility or IV over HV to make sure my option is overvalued or undervalued, or my percentage time premium. Am I doing any of that? Or even looking at volatility for the stock? I could. Beta. I could, but I didn't. I've narrowed down the list to only 47 potential married puts on all 3,200 optionable stocks indexes, all possible stocks and ETFs by just putting in a few basic criteria. My time frame, my range in the money, and my risk limitation, that's set kind of by what I would be looking for in a married put. That's what I'm looking for. Limited risk, told not to go more than 20% of the money, want to go at least 5 months at a time. Basic liquidity and my stock price restriction. And we've only put in 4 criteria for the stock itself. Decent average stock volume, and that's not even too restrictive. Good broker recommendation, decent PE ratio, growth in earnings of 5%, and trading in an uptrend. There's only 47 positions. Now, what John wanted to know is, well, what about the IBD 50? In the blueprint, doesn't Kurt say he likes to screen just against the IBD 50 and the CanSlim stocks? Yeah, but if I've already made up my mind to use a list, I'm not putting in any of these information. I might still use average stock volume, but I'm not going to double filter the search. I'm not going to put in an earnings per share growth, a PE ratio, and a broker recommendation if I've decided to use a company list. The reason why I'm deciding to use the company list is because I believe in that company's selections, and that's what I'm looking for. So I probably wouldn't even use any of the stock filters other than my stock price range, maybe stocks trading in an uptrend, possibly the average stock volume if I was selecting a company list. Okay? So that's basic review. Now, that's just my thoughts. Okay? If I'm doing a dividend search, I might have approached it a different way. I still would have put in what I wanted for liquidity, range in the money, time frame for the months to expiration, and the risk amount. Still would have had to put in my stock price range because I'm not going to look at stocks that are 80 or 90. Why include them in the list if I'd never trade them, right? And then I would have put in my dividend yield of, let's say, 3%, and that would have narrowed it down for me. Then I could always go back in and put in other fields to filter it down further for earnings per share growth and PE. Now, I said this is how I would approach any strategy. What do I mean by that? Well, let's change gears. This was a position looking for insurance, far term, we're expecting growth. What about a position that I wanted to look short-term to generate some income on, but I also wanted to have a limited risk? I don't want too much of a leveraged position or leveraged risk against my potential gain. Well, let's do a standard collar. Okay, so I'll click on collar. And as I mentioned, over on the right here, you see for just the standard collar, which has the same risk-reward profile, the same profit and loss chart essentially as a bull put credit spread or a bull call debit spread. The only difference is the leverage. The at-risk amount percentage-wise is higher because the debit spreads and credit spreads are leveraged. In a collar, you own the stock, so the risks are only going to be about 5, 6, or 7%. What am I looking at in this strategy? Well, the loss occurs if the stock drops, and I make the maximum profit if the stock moves up. So again, that tells me I'm going to be looking for similar criteria that I was just kind of using in the other strategy. But now I can also search for two things. I can still screen to limit the risk to the amount I want by percentage-wise or monetarily because I have a floor, but I can also screen only for those positions that have the percentage monthly return monetarily or percentage-wise I want to see also. Now, typically if I just go into the search, it'll pull up the initial value search for me in the collar spread, which is a basic standard collar screen. And this one is not. I'm looking at conversions here, okay, so that's a different one. But let's go through the same process, and I'll be quick about it here because we only have 10 minutes left. So if you guys have other questions, start sending them in, and I'll just review this very quickly. So, same process. What do I know when I'm going to enter a collar? Well, first thing, I'll scroll down to the bottom and hit clear these settings. I know in the back of my head what I'm kind of looking for. Again, I'm not looking for stocks or paying a price that's greater than $55. So I'll put that in first this time. I know I'm going to be $5.55. In a collar spread, I am buying the stock. I can leverage my capital and get the same kind of risk-reward profile, of course, by doing a bull put credit spread or a bull call debit spread, but we're just going to stick with the collar example for now. All right, my maximum risk, my percentage risk, still the same thing. If I'm using a collar in any fashion, I'm not going to be risking more than that 7.1 or 7.2%. Okay, but I'll let the risk here go down to 1 or 1.5%. My maximum profit or my percentage if assigned, if the stock's trading above my short call, what is the percentage return I want? Okay, well let's say my monthly goal is a minimum of 2.5% return. So I'll just put that in, percent if assigned 2.5%. And my percent if unchanged, if the stock stays at the same price, let's say I want that to be at least 1%. Okay. Now with a standard collar, I treat it the same way I would treat any kind of income strategy. Naked put, for example, covered call, bull put credit spread, bear call credit spread. I don't typically want to go more than typically don't want to go more than 45 days at a time. Really, I want to use the next available month. So let's just choose March. Okay, choose March for my call expiration and my put. I'm selling a call for income and I'm buying an out-of-the-money put in the standard collar to give me some limited risk, but it'll cost me less than the premium I receive from the call. So I'm taking away from the call premium in order to have a guaranteed floor. Now I know that when I'm doing a standard collar, which is what I'm looking at here, I'm going to want my call expiration date to be equal to my put expiration date, so we'll leave that there. All right, now for right now, I'm going to come back to this, but I'm not going to put anything in the ranges for showing the call in or out of the money or showing the put by percentage range or number of strikes in or out of the money, and I'll explain why in a moment. But for right now, I'm not going to do that. Well, I do want the call strike to be greater than the put strike. I don't want them to be equal in a standard collar. I want them to be different. I want the call strike to be above the put strike price. Now, whenever I'm doing any income strategy that is semi-directional, this is directional. If the stock drops, my risk is limited. But I don't want the stock to drop. I want it to go up. I want to make money. So what are some of the things that can cause a position, any kind of directional position, whether it's a bear call credit spread or a bull put credit spread, whether it's a collar here or a covered call or a naked put, we don't want any surprises. So what I'm going to do is check the box here for earnings date to be not between now and expiration. I'll do that when I'm creating any new search in these income strategies. Again, covered calls, naked puts, maybe even calendar call spreads, not looking for an earnings between now and the long call expiration, but the short call expiration. Credit spreads, debit spreads, only want to see those positions that do not have an earnings between now and expiration. Don't want to get caught with any type of unexpected event. Now, because I'm looking at a shorter time frame, another thing that I could do is, hey, I'm going to look for the liquidity that I want to see. Now, there's a lot of things here that you can screen by. We've added a lot of different fields in here based on customer feedback. Call bid price, call strike. Nah, I'm looking for a range. I'm not looking for a specific strike. But you can do that if you wanted to. The implied volatility, I could screen for that, but I'm going to focus more on the volume. As a general rule, and this is discussed in the Naked Put book and the Protective Options Strategies book, the Married Puts and Collars book that I wrote with Ernie, if I know that on average, let's say I'm usually trade when doing a Married Put or a collar, I buy 500 shares and I'm selling 5 call contracts and buying 5 put contracts, for example. A general rule of thumb is I might want to look for a volume that's at least 5 times the number of contracts I'm planning on trading. So if on average I'm around 500 shares or 5 contracts, I'm going to look for a volume today of at least 5 times that, 25 and 25. That's just a starting point. That's just a general rule of thumb. You can go higher than that, of course. We're just going to do that. In addition to that, my open interest range, my open interest range, we usually want that to be about 5 times the number of contracts. 10 times. 10 times the number of contracts. We'll put in an open interest for the call and the put of 50. Now, just with that alone, let's see what our results are. Now, this is also important. When you're creating any new search, after you've put in maybe 2 or 3 different criteria, when you're creating your own search from scratch, maybe every few criteria, go ahead and hit submit. Because if I put in 10 criteria right now, and then I hit submit and I had no results, I wouldn't really know which criteria was the most restrictive. By doing these one at a time, I'm going to be able to see if there's a sudden restriction. Now, I had mentioned that I wasn't putting anything into the range in or out of the money. And that's because I wanted to see how these search results came up first. And these are pretty good for what I normally look for. And I'm saying what I normally look for with an eye to what I trade when I do these standard type of collars. The first one here, and we're going to take care of this in a moment too, but the first one here is that ETN again, VXX at 31.51. We could sell a March 33 call for 135 and buy a March 29 put for 75 cents. That's taking a lot of the premium away, isn't it? I mean, I could make $1.35 if I just sold the covered call. Why am I buying this put for 75 cents? Well, I still get a premium of 60 cents. If I'm right in my direction, after I start doing my research and analysis and the stock or the ETN is trading above 33, I'll make a 6.8% return. However, if the stock falls and drops below 29, we'll only have a 6.2% loss. And if it stays right where it is right now, if the stock hovers right around 31.51, we'll make 1.9%. Excuse me. All right. Max risk is $1.91. Now, the probability of getting a sign is 38. That's something that I'm looking at. And what I mean by that is that typically, when I'm looking to do one of these standard collars, if I have a stock that's at 31.51, or in this case I have a stock that's at 25.69 for SQQQ, what I probably want to focus on more, and I'm sure it's in the list, in fact it is, it's down here. This is more along the lines of the one I would focus on. The percentage return isn't as high, it's 3.8%, but it still matches my goals, and the risk is 5.9%. Why would I choose this one over the one with the higher potential return? Because it's closer to at the money. The stock's currently at 31.51. If I looked at the chart and decided this was bullish, I have a better chance of the stock going above 32 and staying there over March expiration, and wow, I just didn't even realize that. I apologize. That's a weekly. That's the one difference. I am looking for the March option, by the way. Here's the first one. This is a standard March expiration, 22 days away, selling the 33 call and buying the 29 put. The one I was looking for is right there. That's the one I wanted to see, much better. This is the one I was looking for, the standard March, selling the 32, the just out of the money call, still buying the out of the money put for a 4.5% return, 5.3% risk, so lower risk and lower percent return if assigned, but slightly higher probability of that getting assigned. Now, then there's an interesting thing thrown in the mix here. The one I did highlight that was the 32 and 29, that's a weekly option. This one only has 7 days remaining to expiration. And I should have seen that when the net premium was 69 cents. Actually, that's still pretty high. actually selling the short-term call for 85 and buying the other one for 16, buying the put, sorry, the March 29 put weekly for 16 cents. 3.8% return of 5.9%. So if I was interested in that particular position, I might want to use the weekly to get a better annualized return as opposed to the monthly. But I'm including both in my searches, aren't I? All right, but I see a lot of things in here I would never trade. Ultra shorts, SDS, ultra short QQQ, United Oil States ETF, it might be a decent one. But I actually, Bear 3 times ETF, would never trade that. Yes, they offer good premiums, but they are also very volatile and have more of a chance of going against you. So another quick change there, John. I'm going to remove again indexes, ETFs, and holders. Now the ETN I know will still remain. That VXX ETN will still remain because it's not classified as an ETF or a holder. I should really take care of that with the programmers, but for now. So let me hit submit now, still with that same base criteria. And where are we? Okay, we're at 93 results now, so we narrowed it down a little bit more. Now remember what I said though is that I'm trying to look for the positions. Here's a decent example, 4837 IDCC. Well, it probably only has a 50 call and a 45. Probably has 5-point strike differences, so I can't do the single options. This one is, not the stock I'm looking for, but numerically, there's a stock here at 976, selling the March 10 and buying the March 9. You can find a March 8, for example. But what I wanted to stress on this is now that I know what I'm kind of looking for a little bit, I might restrict my range. So I'm not going to let the call be more than 4% out of the money. Okay, so my call percentage out of the money, I can limit it by number of strikes. My percentage out of the money, I don't want it to be more than 4 or 5% out of the money. I want to make sure that I'm getting close to the at-the-money position. Okay, I have a question. Let me just take that off. Is everyone seeing the screen okay? Are we still on the collar parameter field? Use the question pod to tell me if you're seeing the screen okay. Something just came up and it showed me that the audience view went to 0. That no one's able to see the screen. And I'm not sure if the page hasn't refreshed or if something happened with the GoToMeeting platform there. Are you guys still online? Oh, okay, Johnson. Okay, good, good. All right, just wanted to make sure. There we go. Now, okay, everything just clicked up. Fantastic. Thank you, guys. Okay, great. Thank you, ladies and gentlemen. Fantastic. All right, so let me just put in that range there for the out of the money. We had 93 results. Let me hit submit again. And these might look a little bit complex based on the 7.2%. Why are these strange numbers in there? Well, it was just what we wanted to see. It's just what we were looking for there. So this is what we wanted to run, and then we just changed the little adjustment there. I think I know what the problem is. I don't think it's the website. I actually think it's the internet here at the office went down briefly. I think that's the problem that I'm having. There we go. Okay. If I find out that one of the programmers was trying to make a change to the tool while I am on a webinar, well, I am just going to have a talk with them. All right. Let me see if I can go back to the main home menu here. Let's just go back to home and see if that'll come up for us. If not, we may just have to wrap up today because I can't get anything to come up. But long story short, what I was trying to emphasize there on the collar screen is we had narrowed it down to 93 results from large possibility of different combinations. We just wanted to illustrate, of course, that this is how we would approach any search and any strategy. Clear the settings. When you go into a strategy, if you say to yourself, I think I want to trade some bull put credit spreads, what are you going to look for? Well, you want to be a specific range out of the money. You're going to want to make sure that in addition to being a certain range out of the money, you have a high probability of the stock staying below both strike prices in the case of the bull put or above in the case of a bear call. And you have a minimum premium in mind that you'd want to see based on your commissions as well as minimum net credits, and percentage return. And you know you probably aren't going to be trading, think about it this way, in a $50 stock, you're not going to look for the positions that are 20-point spreads or 15-point spreads. No, you're going to be focusing just on maybe on the 2.5 or the 5-point spreads. Those are criteria that you'd put in. And if I'm doing a bull put credit spread, I'm going to want to look for bullish stocks. So again, I can use some of those stock filters, fundamentals, or technicals there and see what would happen. Okay? Jack did ask, let me go to the next slide here. Jack did ask another question. If the stock price changes and there's an adjustment needed, will the tools make suggestions? Well, it's never that an adjustment is needed per se. Sometimes adjustments aren't needed. But what I mean by that, Jack, is yes. If I'm tracking something in the portfolio tool, which I can't show right now because it's still not pulling up my screen. Let me try to see if it's back there now. Yeah, it went back to the home page, but it's still just taking too long to do anything, so I apologize. We'll have to show you that. There are tons of webinars you can go to there, Jack, which will show you examples. Sorry, ladies. There we go. Which will show you examples of this. But yes, I'm tracking a position in the portfolio, whether it's a credit spread, whether it's an iron condor, whether it's a married put, whether it's a standard collar that we were just looking at, a covered call or a naked put. As a stock starts to move up and down in price, from the profit and loss portfolio, you'll be able to link to the position analysis screen, and it will show you opportunities, show a listing of different opportunities with the new percentage return, the new at-risk amounts, the new probabilities calculated for you. And then from those rollout opportunities or those listed adjustments, you'll be able to link to a field, a function for simulate trade, and you'll be able to see them graphically side by side. They're suggestions of what could be done. We're doing the heavy lifting for you and showing you, doing the math behind the scenes, I should say, to calculate that for you. But it's not a recommendation of you should do this. Sometimes you might not want to make an adjustment. Even though one is available, you might not want to do it. And just because an adjustment is calculated for you, it might not match your personal goals or your expectation for the stock going forward. But yes, they are shown there as well. All right. I just want to remind everyone of our upcoming presentations every Tuesday and Thursday at 12 noon. Kurt Frankenberg hosts his Introduction to Radioactive Trading. Sometimes every now and then, every other week, Wednesday at 9 p.m. Eastern Time. Oh, this was the old one. That was using PO for radioactive trades. I meant to take that off. We might be doing an evening presentation next week as well. Every Wednesday at 12 noon, I typically host an Introduction to Power Options presentation. Every Friday at 4:30 p.m. Eastern Time, we host the open discussion that we went through today, where you're free to just come and bring your questions and ask anything that you want. All right, now if you have any other questions we didn't get to, just send me an email to support@powerop.com. We did get through all the questions, but I mean, if you think of something after the webinar, for example, just remember you can call us toll-free during market hours if you live inside the continental U.S. at 877-992-7971. Or you can reach us if you live outside the continental U.S. At 302-992-7971. There are also contact links at the bottom of every page. All right, Jack and John, Mark, it was good to see you finally made it. You were able to get on for a little bit. I'm sorry if you didn't get to see the whole presentation. And Ivan, thank you for your questions as well. And John, thank you for your questions. It's good to see everyone here. Cindy, John, David, thank you all for coming. Everyone have a fantastic weekend, and I hope to see you next week for some of our other presentations. Take care, everyone. Good night.